Good evening, all the joinees. Thank you for joining in. Hi, this is Ashi. I welcome you all for today's NGEN Markets webinar. Meanwhile, others join in. Let us have a look at today's topic. So today we'll be looking upon what are the various risk parameters that can be used for analysis of mutual funds. We'll be looking at value at risk, up capture and down capture ratio, risk versus return scatter plot, followed by drawdown analysis and its recovery, and finally the rolling analysis. And at the end, the forum will be then open for a Q&A session. Now this is the landing page of the NGEN Markets. We'll now move towards the fund section. Now as we move towards the fund section, you can see that this is the screener that we have provided. Now, wherein you can filter the funds based upon the AMC, or you can filter it based upon the categories as well. So as you can see that there are 4 baskets which basically represents the SEBI asset classes, and within which are the multiple categories that are listed. Now there is no limitation. You can select as many categories as you wish. For today's webinar, we'll pick up mid-cap funds. So as soon as you click on this checkbox, all of the 29 mid-cap funds from equity as an asset class will get loaded onto the screener. Now, to narrow the list down, we'll apply certain filter parameters for the same. Now, let's say you only want those mid-cap funds which have minimum AUM of 6,000 CR. So for that, we'll input 6,000 right here. And then you hit on apply for it to take into effect. Now, as you do so, you can see that the result have reduced to 17 such funds. Now, let us say that you also want to remove some of the younger fund from this particular list. In that case, you can use minimum age as a filter parameter. Now here we'll input minimum age of 6 years, and then again we'll hit on apply. Now, as soon as you do so, you can see that there are total 16 such funds that have a minimum AUM of 6,000 CR and minimum age of 6. Now here you can see that there are multiple columns. Now to get all the columns that are relevant for risk analysis, what we'll do is we'll change this preset column view from all column to risk columns. As this gets done, you can now see that all of the risk related columns have appeared onto the screener. Now please note the data that you see here in the fund section for risk related parameter are since the inception, which means the standard deviation, which is a measure of risk, for example, Motilal Oswal, is since the inception of the fund, that is about 17.38%. Next is value at risk, which is basically talking about the value that is at risk of losing basis certain percentage of confidence interval is also since inception. So VAR is an abbreviation of value at risk. So here we can see that for Motilal Oswal, the value at risk is about negative 25.07%, which is again since the inception. Now, as mentioned, it is basis certain confidence interval. Now, what exactly is that confidence interval? For that, you can see in the apply filters, the second last filter mentioning 95%. Now, this 95% is the confidence interval. Now, to understand this better, like what exactly is value at risk and what is the significance of 95%, we load a single fund analysis. Now, for that, we'll click on Motilal Oswal Midcap Fund. Now, as this gets loaded, on the left-hand side, you would be able to see some basic details like the ISIN AMFI code, the asset class, and the benchmark as well. Now, as mentioned, the data in the screener is since the inception because there is no option to select a start date. But in single fund analysis, you get an option or flexibility to input the start date. So as soon as you click on change, you can custom your own start date or you can select from the given option. Now let us first check since the inception. So for that, we'll select inception as an option. Now as you do so, the risk parameter are again mentioned since the inception of the funds. Now let us take a look at VAR. Now in VAR, in the platform, you would be able to see two types of VAR. First being historical VAR, which is historical value at risk, and second being implied VAR, which is again implied value at risk. Now, historical VAR shows the downside risk, what percentage of the fund is losing. So this is basically indicates that with 95% confidence interval, that there is 5% probability, meaning 100 minus 95. So there is 5% probability that if the history were to repeat itself, the fund would go down by 25% and the benchmark would go down by a total of negative 27%. Now, in simple words, if 100 rupees is invested in both fund and the benchmark simultaneously, the capital erosion for the fund and the benchmark would be rupees 25 and rupees 27 respectively. Now you see implied VAR, which is implied value at risk again. The method of calculation for both historical VAR and implied VAR remains same. The only difference is the basis of calculation. For historical value at risk, we consider historical returns, while for implied value at risk, we consider historical volatility. Also, you can see the standard deviation right here, which is indicated through annual volatility, is about 17.37%. This is again since the inception. Now let us say you want to check this for the period of past 5 years. For that, you just have to simply change the start date to 5 years ago. So I'll click on the option change and then select 5 years ago once again. So we'll see that the standard deviation and value at risk has updated accordingly because it will be on annualized basis. Now let us say that you want to compare the risk parameter of this fund with its peers and its benchmark. That can be done by loading the funds in the compare section. So for that, we'll now move back to the fund section. So we'll head back to the NGEN Markets platform. And here is the fund section, which is again the screener. Now there are two methods to load the funds in the compare. First method is by clicking on add to compare icon, which is on extreme left hand side to take the desired funds in the compare tab. So if I click on Motilal, Kotak and Edelweiss, these three funds will get loaded onto the compare section. Or what I can do is I can directly click on add top 50 to compare. So in just one click, all of these 16 funds will get loaded in the compare section. Now, as this gets loaded right here or added, you can also add a relevant index for the same so that it can be compared against the benchmark. Now, the relevant index for mid-cap as a category would be Nifty Mid-Cap 150. So for that, in add other items, we'll search for Nifty Mid-Cap 150 and get it added on the list. As this gets done, it will show up in the blue color row right here. Now here the data again is since the inception, but you have complete flexibility to choose the start date. So for that, what we'll do is we'll click on the settings wheel icon and select a start date. So right beside return columns as a name, you can select a settings wheel icon. Once you click on this particular icon right here, you can again customize your own start date. Now let us analyze this again for the period of past 5 years. So I'll hit on the drop down, select 2020, and then hit on 14th January, and then click on Go. Now, as you click on Go, there will be a prompt stating that a custom start date is being selected. Now, first we look upon is at value at risk for the list of funds right here. Now, this can be sorted in ascending or descending order by clicking on the word VAR. Now, as I sort this from highest to lowest, please note that since there is no confidence interval mentioned, we'll automatically consider this as 95%. So again, with 95% confidence interval, we can see that there is a 5% probability that if the history were to repeat itself, quant mid-cap fund would go down by 31%. That is greater than the fall of that of the index if the history repeats itself. In simple words, value at risk should be as low as possible. Now, in relation to value at risk, if value at risk is higher, the same is reflected in the standard deviation as well. Now, standard deviation is an indicator of risk mentioning about the volatility. And again, the standard deviation of quant is higher in comparison to not only the index, but also to its peers. Now, the next parameter that we'll be looking upon is the Sharpe ratio. So Sharpe ratio is risk-adjusted return, indicating how well the fund is performing in comparison to the risk that has been taken. Now again, as I sort this from highest to lowest, we can see that Motilal Oswal has the best Sharpe ratio, which is about 1.09. Similarly, we can also check for Sortino ratio as well. Now, Sortino ratio also talks about risk-adjusted return, considering the downside risk. Again, when I sort this from highest to lowest by clicking on the word Sortino, I can clearly see that quant has a best Sortino ratio once sorted in the ascending order. So these were for the returns column. Now let us take a look at the relative returns column. So for that, we'll scroll towards the right-hand side. The pink color column are for relative return. Now for the data to get generated, you would be required to click on the checkbox of relative return. Now, as soon as you click on the checkbox of the relative return, there are two pieces of information that you have to keep in mind. First is the benchmark. Now, by default, Nifty 50 is the benchmark that would get captured. We'll change this to the relevant one. That would be Nifty Midcap 150 again. So I'll change this to Nifty Midcap 150. As this gets done, the second piece of information that you have to keep in mind would be the start date. So we'll input the same start date that we have selected for the returns column so that the comparison happens in a fair manner. So we'll change this to 14th Jan 2020 again. I'll click on the drop down, select 2020, and then change it to 14th Jan. Now, as this gets done, the data is now ready for the analysis purpose. The first parameter in the relative return column we'll be looking upon is the beta. Now, beta indicates the risk. Once again, this can be sorted in ascending or descending order. Now, as I sort this from highest to lowest again, we can see index having a beta of 1. So index which always has a beta of 1 is something that we can see right here in comparison to the other funds we have loaded onto the list. Now, if we see that Edelweiss has the highest beta, so it indicates that it is risky in comparison to its peers, but not as risky as the benchmark. Now, the second parameter that we'll be looking upon would be this up capture ratio, and the third parameter in this particular relative return that we'll be looking upon would be this down capture ratio. But to have a better understanding, we'll know about this or learn about this up capture ratio or down capture ratio in a single fund analysis. So for that, I'll click on the fund that I had loaded, which was Motilal Oswal Midcap. And then as I scroll down, you can see right here, there is up capture ratio and down capture ratio. Now, up capture ratio tells us how the fund was performing when the market was in bull run. Here we can clearly see that the up capture ratio of our fund is 98.8. Considering that the benchmark, which is Nifty Midcap 150, was having an up capture of 100, it basically means that if the benchmark was up by 10%, our particular fund was up by 9.8%. Now, once you click on this particular I button, you can also find a month-on-month bifurcation for the same. Please note, here only those months will be taken under consideration wherein the benchmark was generating positive return, irrespective of the fund generating either positive or negative return. On top, you can see the annualized return series of the upward movement. So we can see for the fund, it was about 42.4, and for the benchmark, it was about 73.2. Once you divide this, it will come up to 98.88. This is how we derive to up capture ratio. Now, exactly opposite would be the down capture ratio. So down capture ratio tells us how the fund was performing when the market was in bear run. Again, considering that the benchmark was having a down capture ratio of 100, here it clearly means that when the benchmark was down by 10%, our particular fund was down by 8.3%. Once again, to get a month-on-month bifurcation, you can anytime click on the I button. Now, please note, here only those months will be taken under consideration wherein the benchmark was generating negative return, irrespective of our fund generating either negative or positive return. On top, you can see the annualized return series of the downward movement. For the fund, it is about negative 37, and for the benchmark, it is about negative 44. Now, once you divide this, it will come up to 83.10. So to conclude, up capture, higher the up capture ratio, the better it is. And for down capture, lower the down capture ratio, the better it is. To be more precise.
I have a question out here on the same thing. Can I just ask? This is Nikhil here.
Hi, we would prefer taking up all the questions.
No, this is just a clarity on this particular thing that was covered just now. So
yeah, we actually try to prefer taking the questions at the end so that the
sure.
flow of the webinar is not disturbed that way. Yeah, sure. Thank you so much.
Okay, so just to conclude that higher the up capture ratio, the better it is, and lower the down capture ratio, the better it is. Now, the next parameter that we'll be looking upon would be rollings. For that, we'll head back to the NGEN Markets platform again. And in the compare section, you can find the second tab of rolling. Now, as soon as you come to rolling, basically rolling talks about the consistency of the fund. Now here, the rolling window is about 260. Now, what does this 260 means? So 260 basically stands for 1 year working period, meaning in 1 year, there were 260 working days. Now, this is anytime editable. Let's say you want to check for 2 years. You can just simply multiply 260 into 2 and input the number of days in the rolling window. Also, you can change in the start date and end date as well. And as soon as you do so, you would be then required to click on run for the data to get generated. Now, as this gets done, you can see the very first column consists of all of the name of the funds that were on our main list, including the benchmark, which is at the extreme bottom. The next column that you would see is the average, which is basically the average rolling return. It is the average of all of the data points that are on the graph. Now here for Motilal Oswal, you can see that the average rolling return is about 20.54%. The next thing that is mentioned is vol. Now this vol basically stands for volatility. So anywhere in the platform you see the word vol basically stands for volatility. So here for Motilal Oswal, we can see that the volatility was about 20.56%. The next thing that we'll be looking upon is this high. Now, high indicates what is the highest return that a fund has generated between a specific start date and end date. Now, for Motilal Oswal, we can see that the highest return that it has generated was about 69%. And then we have low, indicating the lowest return that a fund has generated, again between a specific start date and end date. Now here for Motilal Oswal, we can clearly see that the lowest return that this particular fund has generated was to an extent of negative 29%. The next column that we have is range. Now range talks about the swing between high and the low. So higher the range, highly uncertain that particular fund is, which means higher is the volatility. So if I sort this in ascending order, we can clearly see that iProve has the highest range, which is about 118%, which means it can go as high as 77%, but it can also go as low as negative 41%. Now, the last column that we have here is positive percentage. Now, this talks about the number of times a fund has been able to generate return above 0% or positively. Now, for iProve, we can clearly see that 81% of the time, this particular fund has generated a return in positive, or to be more precise, more than 0%. Now, similarly, this ruling is also available on single fund analysis as well. So once you click on that particular fund's name, as a single fund analysis gets loaded, you can find a separate tab for rolling. Now here you can check for 3 rolling windows simultaneously. 260 meaning 1 year working period, 520 is 2 years working period, and 780 is 3 years working period. You can also check for 4 years. Again, if you just multiply 260 into 4, which will basically come up to 1040, as you enter it right here, you would then be required to click on run to take it into effect. Also, you can get both absolute as well as annualized view for the same. Now here for 260 days, we can clearly see that the average rolling return is about 35%. The volatility is about 15%. The highest return that this particular fund has generated is to an extent of 26%, and the lowest return is about 4%. Also, there is a graphical representation for the same, wherein the blue line represents 260 rolling window, black line represents 520 rolling window, and green line represents for 4 years rolling window. Now, if you just want to check for the 4 years rolling window, you can anytime turn off the other two and get a clear view for the 4 years period. So this was for rollings. Now the next parameter that we'll be looking upon would be drawdowns. So for that, we'll again head back to the compare section, and within this compare section, you can find drawdowns as a tab. Now drawdown talks about the strength of the fund to recover from the losses. Now here you can find the details of top 5 worst drawdown. You can see that there are 3 columns. First is size, second is length, and third is recovery. Now size talks about the loss. Length talks about the number of days it was in that loss. And recovery talks about the number of days it took to recover from that loss. Yeah, now you can anytime sort this in terms of recovery and see which fund were able to recover faster from its drawdown in comparison to its peers or index if that has been added for that matter. So if I just sort this from highest to lowest, we can see Quant, there was a loss of about 34%, which took 99 days to recover. Basically, it was in this particular loss for 570 days. Now to get a detailed view in terms of what was the fall in the NAV and the date it took to recover and exactly on what date did it recover, you can anytime generate a chart view for the same. So you would be just required to click on this chart icon right here. And you can see that this particular loss was, which was about 34%, was between 31st August 2019 till 23rd March 2020. Now, in this particular period, the NAV of this particular fund, it fell from 60 to 39, and it took total 99 days to recover, which means it finally recovered on 7th August 2020. There are also certain ongoing correction which is also reflected onto the platform. And also you would be able to find a chart representation for the same. Now here, the gray section talks about the loss period, whereas the white section covers the recovery phase. Now this is also available on a single fund analysis as well. So again, there is a dedicated tab for the drawdowns. As soon as you come towards the drawdowns, you will be able to find the details of top 10 drawdowns. And here for Motilal Oswal, we can see that the worst loss was about 37%, which was between 20 Feb 2020 till 23rd March 2020, wherein the NAV of this particular fund, it fell from 29 to 18, and it took total of 200 days to recover from this particular loss. And it finally recovered on 28th December 2020. And like mentioned, there are certain ongoing correction as well, which is also reflected on the platform. And similarly, you can also find a graphical representation wherein again the gray line represents the loss period and white line represents the recovery phase. Now, the next parameter that we'll be looking upon would be risk versus return. So we'll head back to the platform. And here in the compare section again, you can find a risk versus return scatter plot. Now here you can customize your own start date and end date as well. Now we'll select the start date of 14th Jan 2020 for the 5 years period. And once you do so, you are then required to click on go as an option. Now x-axis consists of risk, which is standard deviation, and y-axis considers return, which is the annualized return. Now it is divided into 4 quadrants, as you can see. On the left-hand side top, it is low risk, high return. On bottom is low risk, low return. On right-hand side top is high risk and high return. And bottom is high risk and low return. Now, if the fund is plotted on the extreme right-hand side, it means that it is taking a higher risk. Whereas if the fund is plotted on the left-hand side, it means low risk. Whereas if the fund is plotted at a height, it indicates higher return. Whereas if the fund is plotted at the bottom, it indicates low return. Now we can see Motilal Oswal and Quant has taken higher risk in comparison to the benchmark, but has also generated a better return. If we further compare Motilal Oswal with Quant Mid-Cap Fund, here we can see that Motilal Oswal has taken a risk of about 19%, whereas has generated a return of about 28%. If we compare it with Quant has taken a risk of about 20% and the return is about 28% again. So Motilal Oswal with a lower level of risk has generated a similar return. So Motilal Oswal can act as an alternate to Quant Mid-Cap Fund without compromising on the return. So you are getting a fund with a lower risk. Now all this is also available on the portfolio level as well. So when you load a particular portfolio, you can find risk versus return scatter plot, wherein you can also find what is the overall risk and return of the portfolio, as well as what is the overall risk and return of the benchmark. For portfolio, it is represented in red bag-like icon, whereas for the benchmark, it is represented in a blue house-like icon. Also, you can find the rolling returns tab in the portfolio level, again showing you for 3 rolling windows simultaneously. And lastly, you can also get drawdown analysis for the same. And again, which shows the detail of top 10 drawdowns. So that is it for the webinar related discussion. The forum is now open for a Q&A session.
Hi, this is Nikhil. Can I go?
Yes.
Yeah. Okay, so going to the upside capture and the downside capture thing which you had shown for the comparison, if we
Yes.
could just go there. In this, along with upside and downside, is it possible to add, or is there some the total capture available, which is nothing but an addition of upside and downside?
Okay. Addition of up capture and down capture is what you're asking,
Yeah,
or
yeah,
a division?
or the total capture across the market cycles.
All right.
Is that available somewhere?
Currently, it is not available on the platform.
Uh-huh.
Maybe we could just see if that could be brought up onto the
Yeah,
platform.
because the data is there, right? So it
Huh.
just needs to be added. But check on your whenever the development cycle happens at your end.
Yes. So
Okay.
what you're saying is just an addition of this up and down capture is what you're asking for?
Yes, which is the total capture ratio. So
Okay.
look at the definition of total capture, which is saying
Okay.
that what is upside? Only when the markets have been up, that is where you see the
Right.
and when the down is when the markets have given negative. But when you look at the whole entire market, which is the up and the down, then you'll have a different number also which comes up.
Sure. So maybe we can note that down as a feedback. If that could be
Sure,
incorporated, would
sure. That
definitely come up
that
on
will
the
be
platform.
great. Yeah.
Yes, sure.
I have one more question on the
Yes, go
rolling
ahead.
returns comparison, which you did again on the entire
List of
comparison part.
yes.
Here, I just wanted to check on the data. How can you generate this for the minimum common period for all the funds together?
Yes. So by default, in the rulings tab, or for that matter, in the compare section, the start date will be by default the young funds inception date.
Okay,
So you go
great,
to the main list, you could sort it basis the age of the youngest fund. So we have the first column called as age. So
correct.
here you see the youngest fund is Motilal Oswal Midcap, whose age is
Okay.
10.94 years old. So
Mm-hmm.
by default, the rolling as well as the drawdowns, or for that matter, any other tab, will pick
Okay,
up the age of the youngest fund, because the purpose of the compare section that way is
correct.
minimum common time period.
Awesome, awesome.
Yeah.
And I can change the end date to anything that I require, right?
Yes, correct. End date you can also change. Even start date as well as possible. By default, it will pick up
Correct,
the
correct,
youngest fund's inception
correct,
date.
correct. Great. Thank you.
Yeah, sure.
Thank you.
What if the funds that we have here
Huh.
is too young, let's say less than 6 months? So then can we just remove those funds from here
Yes,
directly?
possible. Because as I mentioned, it will pick up the age of the youngest fund, which will prevent you from going beyond that 6 months, let's say. Now, if you wish to go beyond that time period, you would be required to click on that delete icon next to the name of the fund. And that young fund will get removed, which will allow you to go beyond that youngest fund's start date.
Okay. So can you just also explain me in the rolling window thing
Huh.
about the simple interest and the annualized? Just explain us these tabs that is available in the methodology
Sure.
and statistics.
Yeah. So annualized. So by default, when you open the compare tab and the rolling window, the methodology that comes up is annualized and the statistics would be simple return. Right now, there are two types of methodologies that you could look upon. One is annualized, the second being absolute. Whenever you select, or rather wish to view just the absolute return, you will be required to pick up the statistics as point to point. Right? Once you select absolute, you select the statistics as point to point, meaning you wish to see the absolute return for each of these funds, which is typically the end date divided by start date. End price divided by start price minus 1. That is how you come up with these each rolling returns. However, when you look upon annualized and it is simple return, we are adding up the daily returns that way to arrive at an average rolling return. So whenever the methodology happens to be annualized, you select the statistics as simple return. And whenever the methodology is absolute, you take up a point-to-point statistics that way.
Okay, so if the client is asking me that he wants to see 3-year rolling return, then I have to select the 3-year period, annualize and simple return, right?
Correct. You select the rolling window as 780, which will be like 3-year rolling window, if I assume you
Can you
mentioned.
just change this?
Yeah. You can input 780, which is 260 into 3, 3-year rolling window. You select the methodology as annualized because it is like more than a year that way, and you hit on run. So now it is saying that if an investor would have invested in any of these fund for any 3 years
But you
from
need
the
to
start
change
date.
the start date, na?
Yes, that depends if you wish to change the start date. You wish to
If I want to change it to 3 years, it will not change
okay,
automatically because it is set as 2014.
correct. So by 3 years, did you mean the rolling window to be 3 year or the time horizon to be 3 year? Because rolling window is you're
Ro-
holding it for 3 years, right?
Yeah.
And you're also mentioning that the
No,
time
it is
horizon
just
should also be
if
3 years.
somebody is saying that 3 years mein kitna rolling return hai, it means that period is 3 year here. So the date should be 3 years, right?
Okay, you wish to keep the date to be 3 year and the rolling window to be 260.
Monthly rolling, I would say.
Sure. So okay, we can change the start date to 3 years ago.
You got the thing,
Yes.
na? That
Yes.
monthly rolling for 3 years.
Huh. So you could select 2022. Now you select the rolling window to be 21. You wish it to be 21, which is monthly basis, right?
Okay.
Yeah. So you
So
can select.
any time when I want to, irrespective of the period, even 1 year, 5 year,
Hmm,
the rolling window should be working days, which is 21 here.
correct. 21 days in a month. That is how we take in
So can
only
you just
working.
read out one data for me? Let's say
Sure.
any fund, so that
Sure.
we
So
have
let's
the
say I'll
clear
take up the
understanding.
first fund itself, which is Motilal Oswal Mid Cap Fund. So it says for this fund, the average rolling return is 32%. Meaning, if you had invested into this fund for any 1 month period, meaning for any 21 days from the start date of 1st Feb 2022 till this end date of 16th January 2025, your average rolling return from this fund would have been 32%.
Yeah, sorry to interrupt here, Aranabhya. When you're looking at 1 month, you should probably change the analyze to absolute. You can still keep it simple, but otherwise the numbers will just look scary. So yeah, there you go. Go ahead.
Yes.
So this is 1 month return here, right, guys? 2.59 here.
Yes, 1 month rolling return for a time
Okay.
period of 3 years that you're looking upon.
Okay.
Yeah.
Can you just explain me why he asked us to keep it simple? Because see, it is relatively a newer thing for me.
Yeah.
So I just want our understanding to be correct so that we
Sure.
can explain the same to the client.
Sure. I'll just tell you why I said simple. The difference between simple and point to point is basically the simple means let's say you have a 21-day period and let's say there are 21 working days. The way the simple return, in this case Motilal Oswal 2.59 is arrived at, is by adding up the daily returns over those 21 days. So the daily return is calculated just by today's price divided by yesterday's price minus 1. And that is done for every day. And in simple returns, we add up these numbers. On the other hand, for point to point, we take the price, let's say today, the price 21 days ago minus 1. And funnily enough, while you might think that those two answers will be the same, they are not. You can even try it in Excel. If you have, let's say, a 20-30 day return period, if you add up the daily returns and compare it to the return that's calculated by the last point divided by first point minus 1, they will be different. Now, we generally suggest people should use simple returns because it takes away the effect of compounding. And especially when looking at rolling returns, you want to actually, effectively what you're doing is comparing various different periods to each other. So here you can see the monthly return back in 2022, and you're looking at it relative to the monthly return, let's say 6 months ago or 3 months ago. So there are different periods, the prices were different. So simple returns is a way of looking at it in a non-biased way. But if you use point to point, it will become the actual return. And that might not be the right way to compare these. So we always suggest simple. We had some clients who wanted to look at it as from a point-to-point perspective as well. So that's the reason we've provided that option. Our suggestion is that you should always just use simple returns because that's the most effective way where all periods are treated without any bias. So that's the reason my suggestion would be to use simple.
Can you just read any of this fund and explain? So let's say
Yeah.
your Kotak Emerging is can you
184.
just,
Okay.
yeah,
Yeah. What is this? So if
how
you
we read this data?
exactly, I'll tell you. So if you look on the right side, you see all these lines on this chart. Right. So here, obviously, there are so many lines because we have 17 funds here. But the line for, let's say, Kotak, that's showing you in the period between Feb 2022 to Jan 2025. We have gone back and calculated every single 1 month period. That means I'm going to just guess the numbers here. So just obviously ignore the exact numbers, but let's say 1st Feb to 1st March. We calculate that return. That's the first point. Next point is 2nd Feb to 2nd March, 3rd Feb to 3rd March, etc. And on and on. So we've calculated every single 1 month period from 1st February 2022 to 16 January 25 and put them on the chart for you. Now, when we took all these 1 month periods, the average return across all these 1 month periods was 1.84. The best one, for example, you can see is 15.28%. So that was a very good month that this fund had. On the other hand, the low you can see is minus 11.7. That's a pretty bad month that this Kotak fund had. So you can see the high, the low. You can also see the range, which is basically the difference between the high and low. So this gives you some idea of how variable a 1 month return is. So you can tell the client that, look, on average, we get just below 2%, 1.84. Sometimes if you're very lucky, it has actually made 15% in 1 month. If you're very unlucky, you could be dropping 12% in 1 month. So there's about a 25% chance, going here, chance around zero to go left or right. But generally speaking, on average, 1.84 is the monthly expectation from this fund if you take a 3-year time period. Also useful is 70, that last number, 70.88%. That shows you how many of the 1 month periods over the last 3 years was over zero. So 70.8% were positive. So that's the kind of, you can even look at that as a probability that there's a 70% chance that your investment in Kotak Emerging Equity Fund monthly return will not be zero. Well, it will be, not be negative. So this is how you can kind of get an idea of these numbers. And finally, obviously, we have volatility, which gives you an idea of how volatile this 1 month period has been. Sometimes it's great, sometimes it's not great. So how variable is it? Obviously, the lower this number, the better it is. If you get a 1.84 average with a much lower volatility, that's a pretty good thing because you have higher confidence that you could get close to the average.
So when I'm comparing the portfolio, irrespective when we upload the cash and everything, so the data when you show rolling return data in the performance sheet also. So that the data that you show is absolute and simple return, or
All simple return.
always, right?
Yes,
As you
yes,
mentioned.
yes.
Any report, when I compare and it is auto download, in your
Always.
case, it is a performance report which also captures the
Yes.
rolling return. Right. Got it.
Yes. Here, the point-to-point option has just been given because some clients ask for it. From our perspective, our suggestion is to always use simple returns for this kind of analysis.
What do you prefer? That the monthly rolling is fine, irrespective of the period?
You see, that monthly rolling window, that really depends on your client's investment horizon. Because if somebody is invested, let's say, into a mutual fund portfolio with a pretty long-term view, they're not really, typically they will not really be bothered with monthly variations that much. They are probably more worried that, in a year I shouldn't be down, let's say, for example. So then you do this analysis with a 260 window, and you can say that there's a pretty high chance that you will not go below zero because historically 90%, 95% of all 12-month periods have actually been positive. So the rolling window decision should really be driven on kind of the investment horizon.
So the 90% that you said, let's say
Yeah.
99% is the word that you use. I
Mhm.
will see that data in plus positive column, which is the
That's
light.
right. You can check it right now. Just quickly change it to 260 and run it again.
So, Arun, normally I think prudence says that 3, 5, and 10 is what you should look at normally, right? rather than
Fair, yes, sir. I
anything
mean,
below
yeah.
anything 1 month or even 1 year doesn't make sense when you talk
Right.
about equities.
No, I agree, sir. I guess I'm just trying to make sure
No,
that
no, I understand.
kind of
I'm just making a comment.
yeah,
Right,
absolutely,
right.
sir. I mean, we can't control what what clients
Yeah,
ask for.
client can ask
I
me
mean,
anything,
I
if
agree with
somebody
you,
is
sir.
I
That
ask
I 1 month, yeah,
so
1 month
that's the
is too
reason.
little a time period.
Yeah, right, right.
You know. But again, I mean, I'm just saying the facility is there. If you, so that's why even default when you see we put 1 year, but you can, you can change it higher, lower as per your requirements.
Arnab, I have one suggestion here.
Yeah.
In rolling compare section, if you give
Yeah.
one more column, which is 52-week high from where are we today, right? 52-week high away from 52-week high. Let's say 80%, 90%, or 5% minus, 10% minus. The current NAV to 52-week high. If you just put one column there, that
Right.
will be helpful.
So how far away we are from the 52-week high?
Yes.
Okay.
Let's say 10% down, 10% down, 15% down, or
Okay. From the so that's the high, like basically in the last 1 year, right?
Yeah.
Yeah, fine. Okay, yeah, that's Ansu, let's write this down. We can add this column.
Yes, sir.
Can I make one request
We
here?
know the
Please.
drawdown,
Yeah.
Yeah, I had a word with my RM already, with Rohan, but as you all are here, so I just want a description, tab to be updated. So when you tell everything over a call about down capture ratio, up capture ratio, and that you are taking the benchmark, the benchmark whenever is positive or negative. So I just need a little brief discussion of all these things. Same with the engine score, because when we add the disclaimer and at the end of the report, and when we send it to the client, he will also understand, and we have the data authenticity, and nothing can be questioned, because sometimes I have presented the report in one or two clients, and sometimes it's tough to answer all their queries, because when we work with your tab, we are using your platform and we are very happy, but we send the reports to the client and not everything. We are not giving him the access as of now.
Right.
So I just want it's just a request that if we have one disclaimer where all these pointers, because all the work that we are doing requires a lot of data to put it together. So even I'll just compare it to the Morningstar thing. They have 10 pages disclaimer, for example.
Right.
So even if we have just 2 or 3 liner, because when you explain it, it is easier.
Yeah.
But
So we
sometimes
can
एक particular जैसे tracking
yeah.
error है या कुछ है,
Fair
if we
enough.
are sorry. So we have, we can explain the same in front of the client.
Understand. We can do something actually. Can we just go to the settings section just to quickly show the customized disclaimer? So here you can customize the disclaimer, but what we will do is, Ansu, let's write this down as well. We will create one from our side which has more information here. And you can use that if you want. So we can provide an
Even
optional
if you
longer
can't give it
disclaimer.
here, you just give us on email. So whosoever wants to update their disclaimer can do that. Because
Fair
see,
enough.
you have all the background, you know all the research and data. So when I write it manually during your training, your detailing will be precise there.
Fair enough. Fair enough. We'll create something. I think what we will do is we'll give you an option here. So if you want, you can set your disclaimer to a detailed disclaimer with definitions, or you can set it to the standard one. So if you just set it once, all your reports will have this by default. The longer disclaimer with all your
Same for engine scores as well, right?
Absolutely. We will explain the score. We will explain all the various
Yeah.
different statistics and our calculation methodology, simple returns, rolling returns, etc. We'll put it all in there.
Yeah. Thanks a lot. Thank
No.
you.
Arnab, has a training been done on the score? I think I have missed it. So is the recording available?
Yes, absolutely. So we have we did have at least one session for fund score specifically. So while we're taking other questions, if someone can just hunt that video down, it's on the YouTube page.
Okay. And in the meantime, also one other thing which I was looking at, when I create a presentation, the correlations part does not get transferred to the presentation. So I have to normally then take a picture or download and then put it into the presentation.
Okay,
The portfolio presentation.
This is the portfolio presentation.
Yes, yes.
Okay, so we do, okay, fair enough. Yeah, I believe that's actually already in our list, but Ansu, please check. If it's not, let's just put it on the working on list.
Yes, sir.
Any other questions, please let us know.
Yeah, hi. I have posted a question as a private message to the host.
Yeah, Ansu, can you just have a look?
Yes, sir.
I don't know who has it.
Yeah, so it says, are these screens available on both the subscription model? Right. So we have two models, light and premium. So what we were viewing today, the compare section, up until the compare section comes up in the lighter version, which will cover everything that was shown, which was rollings, drawdowns, risk versus return. This forms a part of the lighter version as well. Premium version has certain additional features, which are like RTA connection to onboard all your ARN registered clients onto the platform, the option to compare two portfolios, co-branding of the reports that form a part of the premium version. Today, what we saw up until the compare section is available in the lighter version as well as in the premium version.
Okay, thank you.
Yeah.
So have you been able to find the video on the score part?
Yeah, I'm just checking. It's actually, guys, we can just go to the YouTube channel from here. I'm sure we can find it. Yeah, there it is. Yeah, this is the one. So just copy the, can we copy the link? Yeah. Let's just put it on the chat.
Thank you.
No problem. Any other questions? Just please let us know.
Thank you for the session.
Thank you very much. I don't think there's anything else, Ansu. Actually, we can close for today.
Okay, sir. Thank you everyone for joining in. You can anytime view our past webinar recording on our YouTube channel. There's a dedicated webinar playlist that has been created. As of now, there are 143 videos, and today's video will be uploaded by next week. Thank you and happy weekends.